So you bought a stock because your uncle's gym trainer said it's the next multi-bagger. Well, he did have six-pack abs. I thought he knew what he was talking about. Stop investing blindly. Ladies and gentlemen, boys and girls, welcome to the legendary playbook of Ramdeo Agrawal. Yes, you heard that right. He is not a crypto trader, nor a TikTok finance guru. He is the original gangster of Indian value investing. Meet Ramdeo. Doesn't wear suits worth 10 lakhs. Doesn't throw buzzwords like blockchain-enabled AI, NFT, green hydrogen multiverse. Just quietly invests and makes more money than most Bollywood villains ever stole. He co-founded Motilal Oswal Financial Services. He's met Warren Buffett, and more importantly, he thinks like Warren Buffett, but invests in Bharatiya companies that actually make dosas, tractors, or soap. Born in 1957 in the tiny village of Raigarh, in the heart of Chhattisgarh, where electricity was a luxury. Television? Never heard of it. A boy who went from milking cows in Chhattisgarh to managing billions of rupees in Dalal Street. That's the story of Ramdeo Agrawal, veteran stock market investor. Ramdeo was a real genius in stock picking. His turning point came with Hero Honda. Back in the 1990s, Bajaj was more popular than Hero Honda in the Indian two-wheeler market, particularly in the scooter segment. While Hero Honda was making inroads with motorcycles like the CD100, Bajaj's Chetak scooter was a household name and a dominant force. But Ramdeo saw something in Hero Honda that others missed. Zero debt, high promoter holding, strong moat. He didn't just buy the stock, he held it for over 20 years. That one stock multiplied his 10 lakh rupees investment to over 100 crore.
टू व्हीलर का डिमांड तो इंडिया में बहुत है. पर्सनल ट्रांसपोर्ट के लिए यहाँ से वहाँ तो जाना पड़ेगा ना, ऑफिस से जाना पड़ेगा, तो डिमांड तो बहुत है. अफोर्डेबिलिटी इज नॉट देयर. इफ देयर इज अ डिमांड एंड अफोर्डेबिलिटी देन पीपल शुड बाय कार्स, राइट? बट दे कैन नॉट अफोर्ड कार, दैट्स व्हाई दे हैव द टू व्हीलर्स. दैट्स अ चीपर पर्सनल ट्रांसपोर्ट मोड. तो डिमांड तो बहुत रहेगी, मिलियंस एंड मिलियंस में. अब उस समय क्या था, बजाज का स्कूटर चलता था. हाँ, सो दिस वैल्यू वाज माइग्रेटिंग द स्कूटर से बदले में. नाउ द न्यू फैशन वाज बाइंग मोटरसाइकिल, एंड हीरो मोटोकॉर्प वाज नॉट मेकिंग मनी. Just about the first year of making money. Then we said, this migration is definitely going to happen. Worldwide, it is not a scooter market, it is a motorcycle market.
In the 1990s, India's stock market was the Wild West. It was a place where speculation ruled, where information was scarce, and where discipline was rare. Some men chase wealth, others chase wisdom. But Ramdeo was different. He chased both wealth and wisdom with relentless obsession. And one day, he asked himself a question that would change Indian investing forever. What really makes a stock truly great? His investing philosophy can be summarized as QGLP. 4 letters, 1 mantra, a complete framework for evaluating any business, for seeing through the noise, for choosing the kind of companies that could make your wealth grow. It starts with quality. But what is quality? It's not just about products. It's about the people behind them. You see, a great business in the hands of an average management. It's a ticking time bomb. But an average business with great management, it can surprise you. He believed in reading between the lines of annual reports. Who's running the company? How do they talk in conference calls? Do they walk the talk, or just walk away with the money?
But you must understand before investing, how does this guy make money and whether he will keep making money. And what I look for in a stock, businesses where profitability is very high, and most importantly, if it is likely to be very high. Right now low, but likely to be very high, and competition is limited, and there is a huge entry barrier.
G for growth is the second pillar in Ramdeo's legendary QGLP framework. It's the secret engine powering wealth creation. He once said, a company growing at 20% with 25% ROE and no debt. Now that's a wealth compounder. That's the G you want. Ramdeo dives deep. He doesn't just ask, is the company growing? He asks, is the industry itself expanding? Fake insurance in India, still underpenetrated. Is this company gaining market share? Is there room to reinvest profits at high returns? our profit margins expanding, our sales volume increasing. L for longevity is the third pillar in Ramdeo Agrawal's QGLP mantra. Remember Nokia? In the early 2000s, it was the undisputed king of mobile phones. It owned over 40% market share globally. But then, Apple entered, Android emerged, touchscreen mobiles became the new norm. And Nokia? It held on to its old ways, refused to evolve fast enough, and faded. A business that was once a titan failed the test of longevity. It couldn't adapt. It couldn't stay relevant. Longevity isn't about what a business is doing today. It's about how it will remain valuable tomorrow. It is the filter that focuses on owning a company that can thrive for decades. To assess whether the company passes the test of longevity, Ramdeo looks for whether the management of the company is adept to changes in the industry. Visionary management is a non-negotiable in longevity. The company should not be overly dependent on the success of one product. In case of family business, there must be a clear plan of succession. There must be minimal government regulations in the industry. Price is what you pay. Value is what you get. That, my friend, brings us to the final and perhaps the most thrilling piece of Ramdeo Agrawal's QGLP investing formula. P for price. In QGLP, P is the moment of truth. It's where all your research, patience, and conviction meet the market's price tag. Imagine you found a diamond, a rare, flawless one, but the jeweler is asking 10 times the price. Would you still buy it? That's what Ramdeo Agrawal warns against. He says, even great companies can be terrible investments if the valuation is wrong. According to him, a stock should only be bought if it's cheaper than what it's worth. This is called margin of safety. It's your safety net if something goes wrong. It's like buying a 100 rupees product for 70 rupees. It protects you from uncertainty. For valuation of a company, Ramdeo Agrawal uses a proprietary ratio called payback ratio, which is calculated as current market capitalization of the company divided by sum of next 5 years, profit after tax. Lower the ratio, higher the stock returns. Buying stocks with payback ratio less than 1x is highly rewarding. There are some chances of outperformance, even up to payback ratio of 2x.
Okay.
So, this is how investing happens at times because you are investing into the future. The current price is all. What is the current price? Current price is summation of all the earnings in the future, discounted for whatever.
Yes.
Okay. So one has to figure out who is going to make a lot of money.
Okay.
And you can make only that much money as the company makes.
Yes.
So fundamentally, we don't look at the price, we look at the value. At least my job, I have, after a lot of thinking, after 25, 30 years and 20 wealth creation studies, I have realized the only game in town is to figure out who is going to make a lot of money. The moment you are able to figure out, this guy is going to make a lot of money, you should be lucky to know first before others know.
Yes.
And buy it.